If you really like a company but they don't give any dividends and you like the idea of passive income, covered calls and covered puts are the best option for you. First, we need to make a small recap on what happens if you sell options. So let's consider this contract on Apple. We need to sell the 175 strike call contract. The premium on this contract is $4.3. This contract expires after 27 days. So if we sell this call contract at 175, and if we check the profile of this option contract, we can see that if Apple expired below 175 in the next 27 days, we're going to collect the full $430 of premium. If Apple expired above 175, we need to short 100 shares at 175, plus we're going to collect the $430 in premium. That's why you can see our break even is 179.3 instead of being 175. So in both cases, if Apple expired below or above 175, we're going to collect the $430, but the difference is that if it expired above 75, we need to have an additional 100 shares short on Apple at 175. So now let's consider you have 100 shares of Apple at $170. This is the chart of Apple. Right here it's 170, and you as a trader, you want to sell this 100 shares at $175. What a normal trader does is that he waits until it reaches 175 and maybe he sets a sell order at 175 and he waits. What you can do instead with covered calls, you can actually earn an income while waiting the stock to reach 175. If you remember well, if we sell this contract at 175 and we have 100 shares of the underlying asset, we have the obligation to sell 100 shares at 175 if it expired above 175. So let's consider the first scenario. If Apple traded below 175 in the next 27 days, what will happen is that we're going to collect the full $430 in premium, and our average will be reduced from $170 to $166. Why? Because we collected the $400 premium and it will automatically reduce your average. So after 27 days, Apple stayed again $170, and you want to sell again this covered calls. You can actually sell the same contract at 170 after 27 days, and you're going to collect another $400 in premium. And your average will be reduced to $162. So now instead of just waiting to reach 175, you collected $800 while waiting to reach 175. Now the third scenario is that if Apple expired above 175. Remember, we have 100 shares of the underlying asset, and if Apple expired above 175, we need to sell 100 shares. So it will automatically close our position. So now we're going to end up with 0 shares of Apple, but with it profit $500 from the shares trade from 170 to 175. That's $500 in profit. Plus we collected $800 in premium. So that will be $1,300 in profit instead of just being $500. So if you're an active trader and you buy a stock and you have a specific target, covered calls and covered puts is the best strategy you can use. As you saw here, instead of just selling at 175, you could directly sell a contract at 175. You're going to collect $400 in premium, plus you're going to take profit on the shares. If we divide 400 minus 27 days, that's almost $15 per day. You're collecting $15 per day just because time is passing. It's the same thing with covered puts, but the inverse. Now let's consider you're shorting 100 shares of Apple at 180. So this is the price of Apple. Here it's 180, and you want to take profit on those 100 shares at $175. When we sell a put option, we have the obligation to buy 100 shares at the specific strike price that we specify. So we're going to do the same thing right now. We're going to sell a put contract at 175. While waiting for the stock to drop below 175 and we make profit from those trades, we're going to collect an income while waiting. Let's go back to Interactive Brokers and set this 175 contract. The premiums of this 175 put contract, it's $7.6. On this put contract, if Apple stayed above $175, we're going to collect the full $760 of premium. But if it stayed below 175, we need to buy 100 shares at 175, plus we're going to collect the $730 in premium. That's why you can see our average is 167 instead of being 175, because we're collecting premiums. So the first scenario is that we're going to sell this covered put. If it stayed above 175, we're just going to collect the $760 of premium, and we can do this always until it drops below 175. The second scenario is that if it drops below $175, we're going to collect this premium, plus we're going to close our positions from 180. In this case, we're going to make $500 from the shares from 180 to 175. Plus, we're going to collect the $760 worth of premium. The only downside of covered calls and covered puts is that if it goes below 175, let's say it went to 150, we still are forced to close our positions at 175. But since we are active traders and when we get into a stock, we usually set exit targets. So even if I did not have the put contract, I was already going to close my position at 175. So why not earning a passive income while waiting the stock to reach our target? Now I'm going to talk about the pros and cons of covered calls and covered puts. The good thing in covered calls and covered puts is that you're basically earning an income while holding 100 shares of an underlying asset. And the only risk of covered calls, for example, if we did set we're going to sell at 175, the stock actually went up to 200, we still are forced to close at 175. But we can't call this a risk because you're actually taking profit, you're not losing money. And the other downside of covered calls and covered puts, let's take an example in covered calls. If your entry is 170 and the stock dropped below 160 or 150, if we're going to sell covered calls at 175, the premiums will be very low. You can see the more you go out of the money, the premiums will be lower. So hope you understood what are covered calls and covered puts. Thanks for watching and see you in the next video.